Imagine if the stock market was not a mysterious place where only experts make money. Imagine if the greatest investment strategy was not about predicting the future, but about controlling your emotions. Over 70 years ago, a man named Benjamin Graham wrote a book that Warren Buffett later called the best book on investing ever written. This book does not promise quick profits. It teaches something far more powerful: how ordinary people can protect their money, avoid costly mistakes, and build wealth patiently over time. In this video, we break down the timeless wisdom of the intelligent investor, a guide that has helped millions of investors navigate markets without fear, hype, or speculation. Because successful investing is not about being smarter than everyone else, it's about being more disciplined than everyone else. Introduction: Why this book still matters. The Intelligent Investor was first published in 1949. Yet despite being written decades ago, its ideas remain incredibly relevant today. Why? Because the biggest challenge in investing has never changed. It is not inflation. It is not recessions. It is not interest rates. The biggest challenge is human behavior. People panic when prices fall. People become greedy when prices rise. People chase trends. People follow crowds. And these emotional decisions often lead to financial losses. Benjamin Graham understood this better than most. He believed the secret to successful investing was not predicting the market. It was managing your own behavior. This idea became the foundation of what we now call value investing, and it influenced some of the greatest investors in history, including Warren Buffett. Graham believed investing should not be complicated. It should be logical, disciplined, and based on long-term thinking. His philosophy is built on one powerful principle: investors should focus on buying businesses at reasonable prices rather than chasing market excitement. Because the market often behaves irrationally. Prices move up and down based on fear, speculation, and emotion. But over time, the true value of businesses tends to prevail. Understanding this difference between price and value is the key idea behind intelligent investing. The difference between investing and speculation. Benjamin Graham begins the book by making a very important distinction: the difference between investing and speculating. Many people believe they are investors, but in reality, they are speculators. According to Graham, an investment operation is one that, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. In simple terms, investing means you carefully analyze a business before buying its stock. You focus on long-term value. You aim to protect your capital. Speculation, on the other hand, is very different. Speculators buy stocks because they expect prices to rise quickly. They chase trends. They rely on predictions. They often react emotionally to market movements. This behavior is extremely common. Many investors try to guess which stocks will rise tomorrow, or next week, or next month. But Graham believed this approach was dangerous because predicting short-term market movements is nearly impossible. Instead, intelligent investors focus on something far more reliable: the fundamental value of companies. If a company is strong, profitable, and reasonably priced, its stock will likely perform well over time. But if investors buy based purely on excitement or hype, they expose themselves to unnecessary risk. This is why Graham insisted that investors must understand whether they are truly investing or merely speculating. Speculation itself is not always wrong, but problems arise when people speculate while believing they are investing. The intelligent investor always knows the difference. Market, the most famous investing metaphor. One of the most powerful ideas in The Intelligent Investor is the story of Mr. Market. Benjamin Graham created this metaphor to explain how markets behave. Imagine you own a small share of a private business. Your partner in this business is someone named Mr. Market. Every day, Mr. Market offers to buy your share or sell you his share. But here's the interesting part: Mr. Market is extremely emotional. Some days he is optimistic and excited. He believes the business has incredible potential. On those days, he offers very high prices for your shares. Other days, he becomes pessimistic and fearful. He believes the future looks terrible. On those days, he offers extremely low prices. But here's the key point. You are not required to accept Mr. Market's offer. You can ignore him. You can wait. You can only act when the price makes sense. The intelligent investor uses Mr. Market's emotions to their advantage. When prices become irrationally low, it may be a good opportunity to buy. When prices become irrationally high, it may be wise to sell or hold. But the investor never follows Mr. Market's mood. Instead, they remain calm and rational. This metaphor highlights one of the most important truths in investing. The market exists to serve you, not to guide you. Unfortunately, many investors do the opposite. They treat market prices as signals for what to do. When prices fall, they panic. When prices rise, they rush to buy. This behavior leads to poor decisions. The intelligent investor remembers that price and value are not always the same. Markets can remain irrational for long periods, but eventually, value tends to win. The biggest enemy of Investor Son of Graham's most famous quotes is this: "The investor's chief problem and even his worst enemy is likely to be himself." This statement may sound surprising. Many people believe the biggest risk in investing is the market, but Graham argued that the real danger comes from our own emotions: fear, greed, impatience, overconfidence. These emotions often cause investors to make bad decisions. For example, when the market crashes, many investors panic and sell their stocks. They lock in losses because they cannot tolerate the fear of further decline. But often, the market eventually recovers. Those who stayed patient benefit. Those who panicked suffer losses. Similarly, when markets rise rapidly, people become overly optimistic. They begin buying risky stocks simply because prices are rising. Eventually, bubbles burst, and many investors lose money. Graham believed successful investors must develop emotional discipline. They must remain calm when others panic. They must remain cautious when others become greedy. This ability to control emotions is more valuable than intelligence or complex strategies. In fact, many brilliant people fail as investors because they cannot control their behavior. Meanwhile, ordinary individuals who follow simple rules often achieve better results. The two types of investors Benjamin Graham divides investors into two categories: the defensive investor and the enterprising investor. Understanding this distinction helps investors choose strategies that match their personality, time, and interest. The defensive investor. The defensive investor seeks simplicity and safety. They do not want to spend large amounts of time analyzing stocks. They prefer a straightforward investment strategy. Their main goal is preserving capital while achieving reasonable returns. For defensive investors, Graham recommends diversification. This means spreading investments across many companies or funds. By diversifying, investors reduce the risk that one bad investment will cause significant losses. Defensive investors should also avoid trying to beat the market through constant trading. Instead, they should adopt a long-term approach. One of the simplest strategies Graham suggested was investing in a balanced portfolio of stocks and bonds. For example, 50% stocks, 50% bonds. This balance provides both growth and stability. When stocks perform well, the portfolio grows. When markets decline, bonds provide protection. This approach may not produce spectacular short-term gains, but it significantly reduces risk. For many individuals, this disciplined strategy is more than enough to achieve financial success. The enterprising investor. The enterprising investor takes a more active approach. They are willing to dedicate time and effort to analyzing investments. They search for undervalued companies. They study financial statements. They look for opportunities where the market price is significantly lower than the company's true value. However, Graham warned that active investing requires serious discipline. It is not about chasing trends. It requires careful analysis and patience. Enterprising investors must be willing to wait for opportunities, and they must accept that opportunities may appear only occasionally. This patience is essential because markets do not constantly offer bargains. But when they do, prepared investors can take advantage. Why stock prices fluctuate. Many investors become confused when stock prices move dramatically. Companies do not change overnight. Yet stock prices can swing wildly within days. Why does this happen? Graham explained that markets are influenced by short-term emotions and expectations. News, rumors, economic fears, political uncertainty, investor sentiment. All of these factors influence prices in the short run. But over longer periods, something more important takes control: business performance. If a company consistently earns profits and grows its operations, its stock price tends to reflect that success eventually. This is why Graham encouraged investors to focus on long-term fundamentals. Short-term fluctuations are normal. They should not cause panic. Instead, they may create opportunities. When markets overreact to negative news, strong companies may temporarily become undervalued. For patient investors, these moments can be valuable opportunities. The importance of a margin of safety, one of Graham's most famous principles, is called the margin of safety. This idea forms the core of value investing. The margin of safety means buying investments at prices significantly below their intrinsic value. Intrinsic value represents the true worth of a company based on its earnings, assets, and financial health. But because valuations are never perfectly precise, investors should leave room for error. If a company's intrinsic value is estimated at $100 per share, a cautious investor might only buy if the price falls to $70 or $60. This difference creates a safety buffer. Even if the analysis is slightly wrong, the investor is protected. Without a margin of safety, investors expose themselves to unnecessary risk. Many investors lose money not because they choose bad companies, but because they pay too much. Buying excellent companies at extremely high prices can still lead to poor results. But buying strong businesses at reasonable prices increases the chances of success. Patience, the investor's superpower. One of the most overlooked lessons in The Intelligent Investor is patience. Modern markets encourage constant activity. Investors are bombarded with news, predictions, and analysis every day. This environment creates the illusion that investors must constantly act. But Graham believed the opposite. Successful investing often requires doing nothing, waiting for the right opportunities, holding quality investments for long periods, ignoring daily noise. Many investors lose money simply because they trade too frequently. Transaction costs, taxes, emotional decisions, all of these factors reduce returns. The intelligent investor understands that markets reward patience. Compounding works best over long periods. And disciplined investors who remain consistent often outperform those who constantly chase new opportunities. Part 1 Conclusion. The Intelligent Investor is not a book about getting rich quickly. It is a guide for building wealth safely and intelligently over time. Its lessons revolve around a few simple ideas. Investing is different from speculation. Markets are emotional. Investors must control their behavior. Value matters more than price. And patience beats prediction. These principles have guided generations of investors, and they remain just as relevant today as they were decades ago. But Graham's philosophy goes even deeper. In the next section, we explore how investors can apply these ideas through practical strategies, including the difference between defensive and enterprising investing, and the timeless concept that protects investors from costly mistakes: the margin of safety. Understanding your investor personality. One of the most practical ideas Benjamin Graham introduces in The Intelligent Investor is that not all investors should follow the same strategy. Different people have different personalities, different levels of patience, different levels of knowledge, and different amounts of time to dedicate to investing. Because of this, Graham separates investors into two main categories: the defensive investor and the enterprising investor. This distinction is extremely important because many people fail in investing simply because they follow strategies that do not match their personality. For example, a busy professional may try to actively trade stocks without having time to analyze companies properly. Or a beginner may attempt complex strategies that require deep financial knowledge. These mismatches often lead to costly mistakes. Graham believed investors should first understand themselves before choosing an investment strategy. In other words, successful investing begins with self-awareness. Once you understand whether you are defensive or enterprising, you can follow the strategy designed for you and this dramatically increases your chances of success. The defensive investor. The defensive investor is someone who wants a simple, reliable, and low-stress approach to investing. They are not interested in spending hours studying financial statements. They do not want to constantly monitor the market, and they do not want to chase investment trends. Their goal is straightforward: protect their money, earn reasonable returns, and avoid serious mistakes. For most people, this is actually the ideal approach. Benjamin Graham believed the majority of investors should behave defensively because simplicity and discipline often outperform complex strategies. The defensive investor focuses on three key principles: diversification, quality investments, and long-term discipline. Let's explore each of these ideas. Diversification. The first line of defense diversification means spreading investments across many different assets. Instead of placing all money into one company, investors spread their money across many companies or funds. Why is this important? Because no one can predict the future perfectly. Even great companies can face unexpected challenges: economic downturns, industry disruptions, management mistakes, technological changes. By diversifying, investors protect themselves from these uncertainties. If one investment performs poorly, others may perform well. This balance helps stabilize the overall portfolio. Graham suggested that defensive investors should own a wide range of stocks, often through diversified funds or large stable companies. This approach reduces risk without requiring constant monitoring. Today, many investors achieve diversification through index funds, which track entire markets. These funds automatically spread investments across hundreds of companies, and they do so at very low cost. Although index funds became popular decades after Graham's book, they perfectly reflect his philosophy: simple, diversified, and disciplined. Balancing stocks and bonds. Another recommendation Graham made for defensive investors was maintaining a balanced portfolio of stocks and bonds. Stocks provide growth. Bonds provide stability. By combining both, investors create a portfolio that can handle market fluctuations. Graham suggested that defensive investors keep between 25% and 75% of their portfolio in stocks. The rest should be in bonds. A common allocation he recommended was 50% stocks and 50% bonds. This balance offers two benefits. First, it reduces risk. When stocks decline, bonds often remain stable. Second, it creates opportunities to rebalance. When stocks rise dramatically, investors can sell some and buy bonds. When stocks fall significantly, investors can buy more stocks at lower prices. This disciplined approach prevents emotional decisions. Instead of chasing market trends, investors follow a consistent plan. Over time, this method helps maintain stability and encourages buying when prices are low. The importance of quality companies. Defensive investors should also focus on high-quality companies. Graham emphasized selecting businesses with strong financial foundations. These companies typically have consistent earnings, strong balance sheets, reasonable debt levels, long operating histories, reliable dividends. Companies that meet these criteria are less likely to collapse during economic downturns. They may not always produce explosive growth, but they offer stability, and stability is exactly what defensive investors seek. Graham believed investors should avoid highly speculative businesses or companies with uncertain financial conditions. The goal is not to chase exciting stories. The goal is to own reliable businesses that generate profits year after year. Avoiding frequent trading. Another important rule for defensive investors is avoiding frequent trading. Modern financial media encourages constant activity. News channels discuss stocks every day. Social media promotes hot tips and predictions. This environment creates pressure to constantly buy and sell. But Graham warned that excessive trading often harms investors. Every trade involves costs, transaction fees, taxes, and sometimes emotional mistakes. When investors react to short-term news or price movements, they may buy at high prices and sell during declines. The defensive investor avoids this trap. Instead of reacting to daily market noise, they focus on long-term fundamentals. They buy strong investments, hold them patiently, and allow compounding to work over time. This approach may seem boring, but it has proven incredibly effective. The enterprising investor. While the defensive investor prefers simplicity, the enterprising investor takes a more active approach. Enterprising investors are willing to spend significant time studying companies. They analyze financial statements. They search for undervalued businesses. They patiently wait for opportunities where market prices fall below true value. But Graham warned that enterprising investing requires serious effort. It is not about speculation. It is not about predicting trends. It requires discipline, research, and patience. Enterprising investors must develop the ability to analyze businesses rationally. They must separate market noise from real opportunities. And most importantly, they must resist emotional decision-making. If done correctly, enterprising investors may achieve higher returns than defensive investors. But if done poorly, they may perform worse. This is why Graham emphasized that not everyone should attempt active investing. Only those willing to commit time and effort should pursue it. Strategies for Enterprising Investors. Benjamin Graham outlined several strategies that enterprising investors could use to find opportunities. These strategies focus on identifying undervalued companies. Let's explore some of these methods. Buying bargain stocks. One of Graham's favorite strategies involved buying stocks that the market had temporarily ignored or undervalued. Sometimes strong companies become unpopular. Perhaps their industry faces short-term challenges. Perhaps investors lose interest. Perhaps negative news creates pessimism. During these periods, stock prices may fall far below the company's intrinsic value. For patient investors, this creates opportunity. If the business remains fundamentally strong, the market may eventually recognize its value again. When this happens, the stock price rises. This strategy requires patience. Undervalued stocks may remain unpopular for months or even years, but Graham believed disciplined investors could benefit greatly by purchasing companies during these periods of pessimism. Special situations. Enterprising investors may also find opportunities in what Graham called special situations. These situations include events such as corporate mergers, company restructurings, spin-offs, liquidations. During these events, markets sometimes misprice securities. Careful analysis can reveal opportunities where assets are worth more than their current market price. However, these strategies require detailed understanding and research. They are not suitable for beginners. Enterprising investors must analyze each situation carefully before investing. Net stocks. One of Graham's most famous strategies involves something called net investing. This strategy focuses on companies trading below the value of their net current assets. In simple terms, this means the company's stock price is lower than the value of its cash, inventory, and receivables after subtracting liabilities. In these rare cases, investors are essentially buying the company's assets for less than they are worth. Graham used this strategy successfully during his career. But such opportunities are less common today due to more efficient markets. However, the underlying principle remains powerful. Look for investments where the market price is significantly below the true value of the assets or business. Discipline and patience. Regardless of strategy, both defensive and enterprising investors must practice discipline. Markets constantly tempt investors with exciting stories, new technologies, hot industries, speculative trends. But intelligent investors remain cautious. They rely on analysis. They demand a margin of safety, and they wait patiently for opportunities. This patience often separates successful investors from unsuccessful ones. Many investors lose money not because they lack knowledge, but because they lack discipline. They chase trends. They panic during downturns. They follow crowds instead of thinking independently. The intelligent investor behaves differently. They remain calm when markets become emotional. They make decisions based on logic rather than fear or excitement. And they remember that investing is a long-term journey. Why most investors should be defensive. Benjamin Graham strongly believed that most individuals should adopt the defensive strategy. Why? Because active investing requires time, knowledge, and emotional discipline. Without these qualities, investors may take unnecessary risks. The defensive approach offers something incredibly valuable: peace of mind. It allows investors to grow wealth steadily without constant stress. It protects them from large mistakes, and it allows them to focus on their careers, families, and lives without worrying about daily market fluctuations. In many cases, defensive investors achieve results that are equal to or even better than those who actively trade, because simplicity and discipline often outperform complexity. The single most important idea in investing, if Benjamin Graham's entire philosophy could be summarized in just a few words, it would be this: always invest with a margin of safety. Graham believed this concept was the foundation of intelligent investing. Without it, investors expose themselves to unnecessary risk. With it, they dramatically improve their chances of success. But what exactly does margin of safety mean? To understand this idea, we must first understand something deeper: the difference between price and value. Price versus value. In financial markets, the price of a stock changes every day, sometimes every minute. Prices move based on news, emotions, expectations, and speculation. But the value of a business does not change nearly as quickly. The value of a company is determined by its earnings, assets, competitive position, management quality, future growth potential. These factors evolve slowly over time, yet stock prices can swing wildly even when the underlying business remains stable. This difference between price and value creates opportunity. Sometimes the market becomes overly optimistic. Investors push prices far above the company's real worth. At other times, the market becomes pessimistic. Fear causes prices to drop far below the company's intrinsic value. The intelligent investor understands this difference. They do not blindly trust market prices. Instead, they estimate the true value of businesses and only invest when the price offers a clear advantage. This advantage is the margin of safety. Understanding the margin of safety, imagine you are buying a bridge. An engineer tells you the bridge can safely support 10,000 pounds. Would you drive a truck weighing exactly 10,000 pounds across it? Probably not. Instead, you would want a safety buffer. Perhaps you would only allow vehicles weighing 7,000 pounds. That difference between the maximum capacity and the actual load creates a margin of safety. The same principle applies to investing. If you estimate that a company is worth $100 per share, an intelligent investor would not buy it at $100. That leaves no room for error. Instead, they might wait until the stock price falls to $70 or $60. Now the investor has protection. Even if their estimate of value was slightly wrong, they are less likely to lose money. The margin of safety acts like financial insurance. It protects investors from mistakes, from unexpected events, and from market volatility. Why investors need protection? Many investors believe they can predict the future accurately. They trust their calculations. They assume their analysis is perfect. But Graham warned that investing always involves uncertainty. Economic conditions change. Industries evolve. Unexpected events occur. Even the best investors make mistakes. The margin of safety acknowledges this uncertainty. It assumes that errors will happen. Instead of trying to eliminate mistakes completely, it builds protection against them. This mindset is what separates intelligent investors from speculators. Speculators often rely on optimistic predictions. They assume everything will go right. But intelligent investors prepare for the possibility that things may go wrong, and they protect themselves accordingly. Buying value, not hype. The margin of safety principle naturally leads to a strategy known as value investing. Value investing focuses on buying companies that are trading below their intrinsic value. These companies are often overlooked or unpopular. Perhaps the market has temporarily lost confidence in them. Perhaps their industry is facing short-term challenges. Perhaps investors are distracted by more exciting trends. But if the business itself remains strong, these situations create opportunity. Value investors take advantage of market pessimism. They buy when others are fearful. They remain patient while the market eventually recognizes the company's true worth. This approach requires independent thinking because value investors often buy stocks that others are avoiding, and they may hold them for long periods before prices recover. But historically, this strategy has produced extraordinary results. Many of the world's greatest investors, including Warren Buffett, built their fortunes using value investing principles. Why the market misprices companies? If markets are efficient, why do undervalued opportunities exist at all? Benjamin Graham believed the answer lies in human psychology. Markets are influenced by emotions: fear, greed, optimism, pessimism. When investors become overly excited about certain industries, prices can rise far above reasonable levels. This creates bubbles. We have seen this throughout history: the dot-com bubble, the housing bubble, various speculative manias. During these periods, investors focus on stories instead of fundamentals. They believe prices will continue rising indefinitely. Eventually, reality catches up and prices fall. On the other hand, fear can also create extreme pessimism. During economic crises or market crashes, investors may sell stocks indiscriminately. Even strong companies may become severely undervalued. These periods can create incredible opportunities for disciplined investors, but only if they remain calm and rational when others panic. The role of patience in value investing. Value investing is not a strategy for impatient people. Undervalued stocks may remain cheap for long periods. The market does not immediately recognize value. Sometimes it takes months, sometimes years. But eventually, if the business performs well, the market tends to correct itself. Prices begin reflecting true value. This process is known as mean reversion. Over time, extreme optimism and pessimism tend to move back toward reasonable levels. But investors must be patient. Many people abandon value investing because results are not immediate. They expect quick profits. When these profits do not appear, they lose confidence and chase other strategies. Graham warned against this behavior. Successful investing requires patience. Markets reward those who are willing to wait. The importance of emotional discipline. The margin of leverage. Safety protects investors financially, but emotional discipline protects them psychologically. During market crashes, fear becomes overwhelming. News headlines predict disaster. Pundits warn of economic collapse. Prices fall rapidly. At these moments, investors face a difficult choice: follow the crowd and sell, or remain calm and follow rational analysis. Benjamin Graham believed intelligent investors must train themselves to think independently. They must separate facts from emotions. If a company's intrinsic value remains strong, a falling price may represent opportunity rather than danger. This mindset is difficult to maintain, but it is essential for long-term success because markets often reward those who remain rational when others become emotional. Warren Buffett and the margin of safety. Benjamin Graham's teachings had a profound impact on many investors, but perhaps none more famous than Warren Buffett. Buffett studied under Graham at Columbia University and later worked for him. He often credits Graham for shaping his investment philosophy. Buffett once said that the margin of safety is the most important concept in investing. Throughout his career, Buffett applied Graham's principles. He looked for companies with strong fundamentals. He waited for opportunities when prices were reasonable, and he always sought a margin of safety. Over time, Buffett refined Graham's ideas. He began focusing on high-quality companies with durable competitive advantages, but the core principle remained unchanged: buy businesses at prices that provide protection against uncertainty. This philosophy helped Buffett become one of the most successful investors in history. Mistakes investors make without a margin of safety. When investors ignore the margin of safety, they expose themselves to several common mistakes. First, they may overpay for growth. When a company becomes popular, investors often assume its success will continue indefinitely. They pay extremely high prices based on optimistic projections. But if growth slows even slightly, stock prices can collapse. Second, investors may rely too heavily on predictions. Forecasting the future is extremely difficult. Small errors in forecasts can lead to large losses. Third, investors may underestimate risk. When markets are rising, people become complacent. They believe downturns are unlikely. But history shows that markets always experience cycles. By demanding a margin of safety, investors reduce the impact of these mistakes. They build resilience into their portfolios. Margin of safety in everyday investing. The margin of safety is not limited to professional investors. Anyone can apply this principle. For example, when purchasing stocks, Investors can ask a simple question. Is the price reasonable compared to the company's earnings and assets? Or is the price based purely on speculation? Investors can also avoid chasing trendy investments. Instead, they focus on businesses with strong fundamentals and sustainable earnings. Another way to apply margin of safety is through diversification. Owning multiple investments reduces the impact of mistakes. Even if one investment performs poorly, others may succeed. This combination of value and diversification creates a strong foundation for long-term investing. The long-term advantage of value investing over long periods. Value investing has consistently proven effective. Why? Because markets eventually recognize true value. Companies that generate profits and grow sustainably tend to reward shareholders. Meanwhile, speculative investments often fail once excitement fades. By focusing on fundamentals instead of hype, value investors increase their chances of success. They avoid the most dangerous traps of speculation. They buy assets at reasonable prices, and they allow time and compounding to work in their favor. This approach may not produce overnight riches, but it builds wealth steadily and safely. Part 3, Conclusion. The margin of safety is more than a technical concept. It is a philosophy of cautious optimism. It acknowledges that investing involves uncertainty, but it also recognizes that opportunities exist for disciplined investors. By focusing on value rather than price, by demanding a margin of safety, and by maintaining patience and emotional discipline, investors can protect themselves from major mistakes and increase their chances of long-term success. Benjamin Graham believed this principle was the cornerstone of intelligent investing, and decades later, it remains just as powerful today. In the next section, we explore another critical dimension of Graham's philosophy, the psychological side of investing, how market crashes, bubbles, and investor behavior influence prices, and how intelligent investors can navigate these emotional cycles without losing their discipline.